Hi, welcome. This is the Flux News Show where we try and be very trader focused and engaging as we can for wannabe traders and professional traders and the like. So I'm Greg Newman, Group Chief Executive, Onyx Capital Group. I'm joined today with Toddy, who is from our direct trading team and also a guest on Macro Mondays. And Geek in the seat this week is Harinder Sandhu. So thanks, guys. Let's jump straight into it with the temperature of the markets. So markets on fire, guys. So just quick one, like when we say what makes it hot, what makes it cold, we're basically talking about momentum, flows, like excitement, all the rest of it. It's certainly not boring, right?
Yeah, it's absolutely, heart racing stuff on the trading floor. We got to last Friday and I think a lot of people were absolutely exhausted after the weekend. I think people were wondering coming into Monday whether it was going to be a bit of respite, whether, across asset classes, equities, crude, etc., we were going to see some respite. Nope, it's just carried on. It's been hectic, headline after headline. I mean, it's awesome stuff in a way, but terrible
for traders. Yeah, but the volatility, because like everything came in at once. It's like the whole market like kind of needed this implosion. I felt like there's a lot of like pieces moving, but at least people with high conviction for the first time in a while. We got so much to get stuck into, but I guess just to kind of like summarize it, we had obviously the tariff news. Don't need to tell anyone else about that, but I guess, and we'll talk about this in the next section, but OPEC coming out with their headline unexpectedly as well, that just caused a lot of people to just suddenly completely flip their sentiment. And we were actually talking last week and the week before how we were still kind of in an overshort market from a managed money perspective, particularly on Brent and WTI with the CTAs, right? And it was kind of coming out of that. Yet, despite that, we've had the type of move where it's almost like there is an unbelievable amount of stopping out. So I guess that's coming from more of the macro side. You got anything to add?
Absolutely, yeah, Greg. So you're right that we saw CTA is definitely moving down with this momentum. Flat price has fallen well below its support of $71 per barrel. We're seeing like unprecedented moves, super correlated across equities and other risk assets. So it's a move that's affected all the macro markets. So yeah, Brent futures are now trading around $64 per barrel. It really remains to be seen whether there's room further to the downside or whether we can spike up, get back to that 71 support.
Yeah, and I guess just to go back to like the fire concepts, right? Like we said it was a hot market last week because we were trending and people were kind of getting into the market, getting some conviction. But to have such an explosive move, like two $5 moves in a day downwards in one direction and like lots of volume being thrown in, I'm sure there's a lot of blood on the streets, but there's also probably a lot of opportunity for people. And that's about as exciting as the market can get, like you said, Toddy. So good in a way, but bad, obviously, if you're holding a big position. Yeah, and that's kind of like the generic, obviously Brent, WTI, but it wasn't just that, right? This is like all markets, all contracts.
Yeah, absolutely. I mean, speaking to some of the nat gas guys that we've got over on the trading floor, it's been a wild ride for them, headline driven as always, but they saw some pretty, similarly sharp decreases in sort of frontline TTF, etc. And I think one of the most interesting things, especially for a company like us, but for people worldwide, should be seeing how that futures headline risk feeds into the swaps market and the physical underlying.
The wholesalers markets, like the real contracts that are pricing our oil, yeah.
Exactly, because it's all well and good having sort of hedge funds and managed money, having a wild ride, but if you want to see how this really affects you at home, you want to be seeing how it's affecting your heating, you want to be seeing how it's affecting your, commuting.
Yeah.
So that's what we've been, analysing and seeing over the past week.
And there's been just so much to get stuck into. So I think before we do get properly into that, I think we actually need to talk a bit about why the market is reacting to it right now and what it's reacting to right now. Because it's not like tariffs haven't been a thing. And I think it was quite surprising just how much like the outright price reacted to tariffs. So we'll go to the section of herd mentality. So when we say herd mentality, this is how you have to think when you say the majority moves the market, right? The majority is either moving the market in kind of in tandem. So in other words, like last week, I guess we were off the back of traders generally being bullish and generally buying and generally seeing a market kind of grow higher. And then this time it's the complete opposite, right? You have the dangers of a herd, which is all trampling over themselves to get out. In a long market, if people were long, they're racing for the exit doors like indiscriminately, right? So you get the kind of volatility we've seen. So the herd can kind of be a good thing if you're on the right side of it. It can also be a horrendous thing. But ultimately, it's always the majority or the majority of flows that you want to know, what do they react to, why? So of course, tariffs, right? But why do we think it was such a blatant 12% decline in oil as opposed to equities and all that? Because there was probably a case that it could have acted decorrelated to this move, right? And inflation going higher and all that.
Yeah, I mean, it's, in the same way that traders are looking for consensus amongst each other, sort of journalists will look for consensus amongst each other and, look to pass on any blame if they get it wrong. But I think one of the major things that you've been seeing is, obviously, I think a lot of people were looking at each other before the tariffs were announced and saying, is he actually going to do it? He's already bluffed us with the Canada-Mexico stuff in 4th of March.
Yeah.
So is Trump going to be sort of talking the talk and walking the walk when it comes to tariffs? And even if he is, there was a lot of chat about the tariffs only applying to the 15 largest countries, etc., in terms of trading volume. That's been blown out the window. So I think a lot of the wide-reaching nature of this move has been because of the global impact. This is going to be affecting global demand, not just for sort of oil for transport, but for things like petchems, etc.
Well, that's what makes sense now for the herd, right? It's like you see these headlines, you go, oh, it's recessionary. Okay, well, we're going to sell on like a recessionary basis.
Yeah.
But I guess if you rewind back, you'd be forgiven for thinking tariffs coming in like they did for Canada and Mexico, it's not really going to affect the outright prices. And I think that's actually what we said week one. We were like, the way to trade the tariffs was like the gasoline arb between, New York Harbor and EU, like those kind of movements. We were saying it's going to affect logistics. Affecting the outright price, I think it's fair to say people weren't expecting that.
No, and I think also, the herd mentality before was that these tariffs were a bullish factor, like, the secondary tariffs on Russian crude. This is what people were sort of talking to each other about in corridors or on Twitter or whatever. And that was the idea, was that, okay, well, the guy next to me, this guy at X fund, based in New York, he's bullish. Like, of course, tariffs are bullish. And then when you actually look at it and you see that there's a huge wipeout in confidence in, the US macroeconomy, but then global macroeconomies, people are just flocking and, perhaps taking profit or stopping out on any of the shorts that they had.
Yeah, and I think the CTA is going back to that. Harinder, right? Like that's at the end of the day, like if they were already short and potentially getting longer, but then they would have been on these move downwards, probably getting back in short again. So they're probably max short. How much of an impact do you think they've had, or do you think they've actually been like whipped around?
So I think, there's kind of two sides to that. They obviously trade on momentum, right? And this is a really aggressive downward move, so they're likely to have become progressively more short. I think that now will be an interesting time because we're seeing support around $64 a barrel. As to whether they continue, that the trend continues downwards, CTAs will pile in more aggressively. I think on the point that you were making earlier as well, Trump was on the sort of tariff point. Trump was especially careful with Mexican and Canadian crudes, so they were exempt from the US MCA tariffs. So you could see why perhaps back then people would be much more cautious. They're thinking Trump's being more cautious towards oil, and he's trying to keep prices suppressed. He's not trying to, impose tariffs leading to, prices roofing, inflation, that sort of thing. So back then, you could have thought perhaps he would have taken a much more conservative policy towards tariffing other countries. So especially to lead to prices moving so aggressively. So yeah, I think that's another point that you'd think back then he was being much more tame, but now of course he's cat's out the bag. He's being super aggressive, and then recently we saw him, threatening 50% extra on China as well.
Yeah.
So just really, really aggressive.
I think implications for the industry is important to acknowledge here as well, because we've had 2022, which was, a monster year for oil profits and energy profits. And the big theme in then 2023 and certainly 2024 was hedge funds coming in. And this is like the classic portfolio manager, basically discretionary portfolio manager, who people thought that was dead, right? People thought that's not how you get into hedge funds these days. You either need to be super systematic, algorithmic, or your physical trade house. But this was the return of the kind of punting, speculating hedge fund that came in droves. But basically, let's be honest, all to go long, right? Ultimately to capture TTF, the natural gas, the power prices having their 300% moves or whatever. And look, that did kind of pan out to some extent in 24, right? You had like huge moves in TTF. And then we were set up this year for a very big bull run again. And the market was talking big kind of bull. This is natural gas I'm talking about. So in other words, the Russia story was still there for the market. And the commodity story's been there, the energy boom, the fact that you've got to have exposure to energy prices because it's going to be inflationary hedge. It's also like we're going into this regime. Now that's just all been shut down. Like Trump did come out very clearly saying, this is the end, right? I want oil prices down. He's a traditional oil guy. He sees that as a reflection of the economy. He wants that down, and then he wants everything else to come with it. That's what he said. And I think the counterpoint was like, yeah, what are you going to do though? Because you were talking about drilling more oil. You can't really drill much more oil with the wellhead situation and all that. You can't get OPEC to play ball. Russia's still sanctioned. The war's still happening. So there was a lot of doubt. And then, all of a sudden, bam, we have, obviously the ceasefire was one thing, but that was very much a sentiment thing, right? That hasn't really transpired into any physical changes whatsoever, even on the horizon. But this right now, could anyone have predicted like the way to get oil prices down this year would have been an actual like inducing a recession, basically.
Yeah, scare everyone into these huge fears.
Well, it's a demand story now.
Yeah.
And I don't think anyone expected a demand story. They expected a supply story this year. So it's just suddenly flip it into a demand story. You say, well, Jesus, even if my balances or supply base are looking like not too good, but okay. If you just erode any kind of demand, it's so brutal. Like the 3 or 4 sell-offs I've seen since I've been trading, like dramatic sell-offs, like the market has been in backwardation. The time spreads have been in backwardation. The physical market's actually been healthy from a supplies perspective. Like imbalance. So demand can really just screw markets. But sorry, you were going to say something.
Well, I was just going to bring up on the topic of like funds and CTAs, because if they were sort of maxed out short, one of the narratives in gold this week was gold is a fantastic trade being long because it's a good inflation trade.
Yeah.
But it didn't see the price action that you would have necessarily thought, because people had to liquidate that position in order to sort of balance the books with other, the fund managers having lost their asses on equities or whatever.
Yeah.
So I wonder whether if people were sort of maxed out shorts as much as they could be in terms of flat price in Brent, whether this will be something that they're now starting to have to take profit on, and whether you will see that sort of support at $64 perhaps creeping up as people are taking profit on that and sort of covering their losses.
No, this
in
is
other
great
assets.
because I think we do need to translate this about trading, right? This is what we want to do in the show. So trading this move downwards. I mean, the best ways to have made money is not easy. I think you probably would have been looking more at the kind of the diffs and some of the things that have been either like oversold or overbought kind of in no man's land for a while, like gasoline, although it was rallying, like real breakouts in some of the contracts that have been a bit slower to get going this year, like VLSFO, things like that. But volatility, I think, was the main thing. It's very hard to trade volatility unless you're in it already, but volatility was like on its relative lows. I think like that whole idea of like, we can't quite break through 70 because every time we do, there's like all this buying support again. And then we have a nice orderly rally up to 74. 68 to 74 now doesn't look like a big deal at all. But at the time, it's very like, finally, we're getting a bit of a move here. But that's a very like low vol move, right? Markets, when they tend to move up, are lower vol than when they move down. And this is like the perfect case in point. So if you had gotten long volatility in some form, that was the way to really profit from this move. But again, why would you have seen that coming unless it was a long-term position or whatever else? So let's just put ourselves in the shoes of the traders. Friday happens, right, and it goes absolutely nuts. Like, what is the first thing? What can you do as even say like a professional trader sitting at home?
Yeah, I mean, in terms of figuring out what's going on next, it's a tricky one, because you have to question whether something has fundamentally changed when, you've been in, as you were saying, such a low volatility period. To see a breakout, okay, immediately you need to think, reassess my principles. If I've got any trade on, do I take it off? And if I'm looking to put a trade on, am I going to, carry on with the momentum?
Entry price here, or
Exactly. And the entry price stuff is very interesting to see. If you'd have entered on Thursday evening before the OPEC announcement, you might have thought that OPEC might come in and actually defend a position here and say,
that's what you would have thought.
We're going to be cutting for longer, but to see them sort of pile in, all right, cool. Well, now I need to reassess. Prices coming off. Now, okay, I'm thinking supply demand globally. Has much change on the supply side? As far as I can tell, not a huge amount. Demand side, I'm not necessarily sure that we're going to be seeing Chinese exports into the US coming in as much, but is there that much changing? So I think I would have been tempted to be similar to how in equities retail was buying the dip.
Yeah.
I think I'd be tempted to put some length in at these sort of lower levels. 62 sort of dollars per barrel feels like a good entry level. Might have missed it by now, but
well, no, I think that's a great point, because generally speaking, what was going on, I think we got some snippets from X, some of the oil traders and guys who are popular there. There's only 3 or 4 of them, I think, that have a bit of a name and talk, but ultimately it was about Brent spread still being strong, the time spread still being strong, the dated Brent market, basically all the contracts that reflect the real physical market were basically that was immaterial. And if anything, they've rallied like even stronger in the very spot. So it's the time spreads a bit more further out. They've been under pressure, but generally speaking, like exactly as you say, you're looking at it going, okay, this is a monster move. I can either sell into it from a momentum basis, from a day trading basis. And look, to be honest with you, that wouldn't have been the worst thing, because as you said, if now OPEC are coming in with their headline on top of the tariff move in the macro, you can think, well, the longs are going to be under pressure here and they're probably going to stop out. So as you continue to see the volume piling in, getting involved in that from a technical basis for a short-term day trade probably would have been it would have been relatively not straightforward, but you could have made money doing that. But now that volatility is high, you're in a tricky situation. So if you flip that and say, is this a good entry price, like you say, well, you could have looked at the material we're throwing out there for free, or wherever you can get your data from. Look at the contracts and the time spreads. Are they correlated to this move? Like, is this like an oil market like global shutdown? Because in that case, a move like $10 lower on flat price, Brent and WTI, is contango spreads for sure, right? Because it's like, usually that is the market's just completely structurally flipped, whether it's COVID in 2020 or it was 2014 when the market just suddenly started to price in all the shale oversupply, and you see everything get crushed. So anything you can get your hands on from a crude perspective, you sell. Like the product cracks tend to be okay because it's like an inverse of crude, but generally speaking, you sell time spreads of every product, time spreads of every crude, diffs of every crude. Now this time, none of that. Product cracks rallied, right? We had EBOL crack, RBOL crack rally, the key contract there. VLSFO rallied. Basically everything rallied apart from the outright price. Yeah. So you made a great point. You're saying there like a bit like Jesus, like that's the first thing as a trader, right? You're like, what is going on? But if you can just objectively look at these things, you've got a good entry price. If you're bullish, basically, if you're long-term bullish, you've just been gifted like a 12% lower entry price. But that's, easier said than done. But why don't you whack up the Brent price, the Brent chart, so we can look at it like from a technical perspective.
Yeah. So if we look at the chart now on my screen for flat price, so we can see here that clearly before we were testing sort of getting up to that 200-day moving average last week around $76 per barrel. That's been firmly sort of rejected, and we're on our way downwards now. We're at 63.77, blown through that $71 support, dollar per barrel support that we used to see. And I think now, to really get an idea of where we're heading, we need to start looking at sort of Fibonacci retracement levels. So if we look at the Fibonacci retracement levels from sort of around April 2020 to the peak of the rally in sort of March 2022, we can see that the kind of 61.8% level is around $64 per barrel. So that's going to be the next sort of floor that we can expect Brent to see support at. Because I think given the fact that it blew so aggressively through $71 per barrel, obviously market participants right now are thinking, where's support going to be found? Mm-hmm. I think we can make an argument that around about these levels, we should start seeing some sort of floor. Failing that, the real next level of support is way down around $43 per barrel, if from the technical perspective. So, yeah, I mean, it's been such an aggressive move that we have to go this far back to around 2021 to really get a picture.
I think we've got to see more from what we're talking about. Macro oil is in like a real shift in the entire oil complex that it's just not there yet, is it really?
Yeah, I think it's also, very useful if you have data overlays and you're able to do technical analysis like this, and then you're also forming a fundamental macro opinion. This is, such a useful asset in order to be able to go and like stake something. And whether you think, okay, the outright flat price, buy the dip, or whether you also don't see necessarily issues in the supply chain, so maybe you want to trade one of the Brent spreads or whatever.
Yeah, I was going to say that as well. Like if we're saying the Brent spreads haven't really moved and they're almost like dissociated away, they've still been like, pushed down a little bit. From an entry price perspective, if that's been held up on the way down, that's a massive buy as Brent flat price tends to perform. So if you could almost just wait and see right now. And if it starts to steadily trickle up 66, 67, 68 Brent, those kind of levels, you've got decent momentum to buy into there on the Brent spreads, because last Brent expiry, and which was last week, we got to like into the triple figures, right? A dollar plus, and you could enter around 45 cents right now on the front Brent spread.
Yeah.
That's a good buy if you're bullish, right? And if you're bullish for basically the market being healthy point of view. But let's move on, because we've got loads to get through. So let's talk about people making money. Ultimately, how they did it. This is the gold rush. Okay, so with the gold rush, we're trying to find the contracts that people did well on. I think we've just said it, right? The Brent flat price, can't see a hell of a lot of people making money out of that. Brent spreads, we know people were long, and that kind of trickled lower, so doubtful there. So the generic contracts probably not so much in crude. But Harinder, where do we think is one like that we're pretty sure the market made money on?
Yeah, so I think in terms of the gold rush, really it's kind of deferred MOPJ cracks, deferred naphtha cracks. Q3 is the particular tenor we're looking at. So if we maybe show...
Sorry, Speaker, you think the deferred more than the prompt, yeah?
I think so. I think the prompt was, I guess you could say, the move, well, the kind of argument from weakening petrochemical demand and weakening sort of manufacturing demand in China could have really aggressively moved the prompt contracts down. And we can have a look at the dashboard as well.
Yeah, let's do that. But ultimately, like why naphtha, let's explain it a bit. Like naphtha is a good proxy, as you said, for petrochemicals, industrial demand, particularly out of China, gasoline blending. Yeah. But ultimately, I think it's just a good proxy for industry really in oil side of things. So it's recessionary, right? When there is a recession, when there's recession talk, naphtha does sell off big time. So it's a good contract to choose. But we've been talking about naphtha quite a lot in the last 2 weeks. The market's been building up like decent shorts in there. So it's a good follow on that, yeah, the market then came off. You'd expect people to make money. So yeah.
Exactly, yeah, absolutely. So if we maybe go to our Onyx Capital dashboard, which is our proprietary sort of data platform where we showcase all of our contracts and showcase the positioning that we see. So this is the Q3 naphtha crack, and we see that shorts have been building up sort of over time quite considerably. Lately, they've taken, you can sort of see the positions have been coming off, which could indicate taking profit as prices have fallen even lower. But this kind of, underscores the fact that our counterparties have been selling quite heavily short in Q3. And if we look at the October leg of this contract, the entry level that we saw was around negative $4.76 per barrel.
So hang on. So right now we're looking at which counterparts, right?
So these are trade. So if we go down a little bit more, we can see sort of who's been doing what. So trade houses, refiners, majors, end users, all on the sell side, with trade houses the biggest positions. Market makers and banks slightly on the buy side.
So in order to absorb liquidity from all these sellers, basically the market makers are getting it from other contracts.
Exactly.
So basically they're buying, buying that for selling, I guess probably propane and gasoline for liquidity. So it would have been the differentials between those that would have got pretty impacted. But sorry, you were saying there's the entry prices.
So entry prices around negative $4 per 80 per barrel for the October leg of the quarter. We can see the entry prices clearly for shorts here around that negative $4 per it was negative $4.76, negative $4.80 per barrel. So they're pretty comfortably in the money. And yeah, that's what our data shows.
I mean, Todd, you're on the Lightens desk, gasoline, naphtha. I mean, naphtha as a short has been talked about for a while, right, in the market?
Yeah, I think there's been, there was a serious buyer of the Cal 2025 European naphtha crack through the latter stages of last year, sort of Q3, I think it started. Yeah. That exposure has been largely rolled into Cal 2026. Yeah. So there was a significant long in the European naphtha crack, and I think a number of people thought that it seemed to be coming from one origin, and that player must have made a significant amount on it. But I think a lot of people were saying, well, this is at lofty levels here, this doesn't make sense. So there was a lot of will amongst a plethora of market participants to get short the naphtha crack, and that was particularly focused in Northwest Europe. But one of the things that I think is particularly worth noting with this is how much of a bearish signal this is, the naphtha crack and the MOPJ crack coming off on this lower crude. Because, one thing that we know like bread and butter, but it's worth explaining to the viewer, is that when crude comes off and you see flat prices decreasing for the outright, sort of whether it be MOPJ or Northwest Europe contract, you typically see people buying on a flat price basis, to whether it be to hedge their physical on a flat price basis or because diffs to petrochemicals, etc. work. So typically when crude comes off, naphtha is supported. This has not been the case. We've seen a naphtha collapse whilst crude has been coming off. So I think a lot of people have been saying, sod this guy that's long. I don't back this. I want to get short. They have been getting short. We've got, indicators of global recession, weak demand, naphtha dumper.
Yeah. No, there you go. And I think there was also decent strength in the prompt from, I think we were talking about Major a couple of weeks ago, and that's kind of since dissipated. So, another bull kind of taken out of the market. So it's definitely in line with the herd. It's just when it gets like this and you finally got a bit of relief, now what, right? Because a lot of people in the money, fine, but not massively for a crack. So are they all going to try and get out at the same time? And when do they get out? So it's going to be interesting to see. I think generally speaking for these kind of contracts, that's why it's quite different from trading a classic future like Brent or WTI, is that these trade houses and majors will probably, who hold the bulk of the risk, they'll probably price that out. In other words, they'll take it all the way to the end. They'll let physical then set the price and it will expire cash settled, so they don't have to roll it, right? The thing about a future is if you've got an enormous position, like most people don't take that to expiry, they then get out of it. So you have to factor in liquidation, but you don't really in that for. If anything, it changes to, right, if there's such big amount of open interest on the sell side, then you've got a lot of committed physical players who are going to throw volume at the pricing. In other words, like they've got pretty high conviction that the market can't take the supply that's there. So when you come to the tendering windows that the price reporting agencies use to settle the price, they just let that do the job. So in a weird way, it's kind of like easier to trade in that in sometimes, right? You still get huge reversals and huge stop outs, but generally speaking, you can be a bit more protected than futures, wouldn't you say? And that
I would agree, and I think it's always worth considering that if you've got some of these significant players, these majors that have conviction, if they were to sort of unwind their position, that inherently means that they're going to be crossing bid offer twice. They don't like that. They want to, if they had conviction once, unless something fundamental has changed, and as we saw last week, European major did have their conviction changed or had to stop out of their position. But unless something fundamental changes, quite often they just like to increase size on their positions, if not just run them. So it's a momentum product, and it quite often sort of goes in waves of 2-3 months, etc. I think that is what we had been seeing.
Okay, have we got the graph? Just because I guess if you're a trader out there suddenly learning about this, you believe the sustained impacts of the recession, things like that, you've got a decent trending down trade, like you said, Toddy, and it is quite trending. So this is going back, this is
back to kind of a late March,
Late March. So yeah, it's on pretty nice trend down. So ultimately, what are we talking historically? We're at -5, 550 type levels. Yeah. I mean, for me, a normal crack in NAF of -8 would be pretty normal. So I guess by no means are we on the low side, but we are on the low side kind of in the last few years, would be fair.
Yeah, but you do still, start of 2024, we were looking at the Cal 25 naphtha cracks, so the sort of year +1 naphtha cracks at far lower levels than what they are now. I think Cal 26 naphtha cracks are at sort of -$6 per barrel now, which in comparison to a year before is quite a high level.
Okay.
So I think there's
So let's go back to the graph then, just because if we're jumping in on this trade on the sell side, we want to join in. I mean, you've got actually a bit of a consolidation after that dump. You can still, you've circled it, right? Harinder, that green bit is where you're saying, okay, that was the big move of Brent really with it. So followed it, like Toddy said, or even outpaced the Brent decline. We've since consolidated and we are dancing around right now, but it's a good re-entry level ultimately if you think it's going to sustainably weaken, and you kind of take that view. I mean, regardless if you do or not, do you take the view that your momentum's it's a good entry price, right?
Yeah, I like it. I think it has potential to roll down, and whether you choose to sort of focus on Q3 or, to be honest, I think the whole of the curve is primed for a bit of weakness. We've seen.
Sorry, we're talking Q3 here at -3. So I was thinking about the prompt, which is about -5, right?
Yeah.
Okay, fair enough. So Q3 is absolutely on the high side.
Yeah.
So Yeah.
So I think there are a number of good positions to potentially enter into a short through the naphtha complex. And, one of the things I would caveat this by saying is looking at the key differentials, whether that be to gasoline, whether that be to propane. And I think, from the gasoline perspective, we'd actually been seeing on lower naphtha and sort of steady gasoline, we'd seen gas nap selling, which had provided a bit of support to naphtha here. To see this support still be met with floods of selling and not any real revival, I think yet again you've got to be.
So just explain, gasoline being strong, gasoline prices rise and naphtha prices weaken. That makes naphtha quite attractive to buy and blend into gasoline. So that's what you're getting at there.
Exactly.
That flow's come in and not really had much of an impact.
It hasn't budged.
Which is yet another bearish indicator. Sorry, I hadn't fully appreciated. And this is the thing about forward curves, right? You're focusing on the spot price, the most prompt price you'll see at minus 550-ish. Well, hang on, the Q3 is 330. Like historically, that is high. And you've got a great entry level to kind of re-enter short. So what are you doing? You're basically just hitting the bid where you can. It's actually moving now already downwards. All right, so we have a pretty nice setup here, right? So we like being short naphtha cracks. We think it can trend lower. And we've got that blue line, right? Which is quite a nice 200-day moving average, which is about where, Harinder?
About negative 246 right now. Okay,
so minus 246. Yeah, that's got to be a good stop, because if you move beyond that point, you're well out of the downward trend, right? You've had pretty decent spike from just like kind of looking at it like that. So I would say that's a very nice stop to put in. So if that's where your stop is and you're just hitting the bid at entry price, kind of 360-ish, what are we thinking, Toddy, for a decent target price?
Yeah, I think if I were, I was wanting to capitalize on the momentum here, I'd probably want to at least hit that negative $5 per barrel move. And ideally, I could see this moving down to $7.50 or so. So I think
because I think if are we saying this is a structural move, because the prompt already is 550. So if Q3 just to catch up with the prompt at 550, that's quite likely, right? If it's going to trend. So we think, or the market thinks, there's been a longer
structural
term
rather
move.
than momentum.
Well, both. I would say it's a structural reshift that you can believe in. A bit like what you were saying about Brent earlier.
Yeah.
You were like, has enough changed for me to actually sell at 64? Not really. It's actually quite a good entry on the buy price, but this is the reverse, right? There's enough change in naphtha. The market wants to sell it. The market's been trying to be short for a while from a physical perspective. So you'd expect quite a decent move into historical norms, which are probably more like $7.
No, definitely. And I think things can, go back to where they were perhaps at the start of 2024 at lower levels on sort of cow crack being reflected. So yeah, I think it could easily, especially with, weaker petchem demand and, this gas nap selling not being met with support, you're going to be seeing a lot of weakness coming into.
It's a good point, actually, because propane we're going to talk about in a bit, and that it kind of very correlated to naphtha, and that's been dragged down very aggressively as well. But anyway, just to quickly set up a trade, we've got, a decent risk reward here, because we're saying $1-ish, $1.20 stop. And we've got, at least kind of $4, maybe even $5 per barrel, just a very simple kind of 4-to-1 trade there, risk reward basis. But you could even enhance that, because we've got so far to go, we think, that you've probably got a scale in there, right? So if you scale in, you're basically, if you're going to double your volume from your initial entry, then what you're going to do is use the money from the move you've just made. So let's say your scaling point is kind of like $1.50 lower to around about $5. Then you've got basically the money you've made from 350 to 5 plus the initial $1,000 or whatever you risked to begin with, and you add them together for this new entry price, and that's what gives you the leverage. So suddenly you've got double the risk on, but because you're in the money, you're okay with that, and you can keep the same stop or even a slightly higher stop. And so you've completely protected your capital. So suddenly your $1,000 that you were looking to make 4-to-1 on, you could suddenly make 8-to-1 on, right? Or 10-to-1 on, which is what makes these kind of setting up your trades so powerful, right? If you do this well. And we can go into more depth on this later on, but ultimately, that's a really good setup to basically sell into a trending trade, wide stop, one scale in, and target probably around minus 750 to even 8. And I would say at that point, you've made probably like $4 on an average entry. And you want to maybe take off half at your kind of reasonable target limit, but you do want to run the rest, right? In a trending trade, markets tend to be moving from an overbought to oversold scenario all the time. So you don't want to miss that kind of oversold part. So you want to run that winner. How do you run a winner? Well, yeah, you take some off and you basically ratchet up your stop, ratchet down your stop in this scenario. So you would be moving your stop, like basically, there's a number of ways you can do it, but I always like the daily ratchet stop. So you would basically say, I don't know, it's a trailing stop of, let's say, $2. And then if it closes a bit higher, let's say it goes 50 cents higher, you keep the stop at like 150 and you keep ratcheting down to like the new lows set every day. And it basically squeezes your trade. So if the market's like lowers down in volatility, the ratcheting stop will catch up and basically stop you out at some point, which is kind of what you want if you're just letting the market do its thing. But at the same time, if it keeps running, it allows you to stay in the trade. So I really like ratcheting stop losses, and I think I'll do a video on that later on. But either way, that's pretty good setup. But let's move on. So we've got that's the kind of money makers, we would say generically. What about the money losers in the last week? This is the widow maker. Okay, so obviously, rather than the big volatility kind of losses you expect on the macro side on Brent, what about in the more of the industry? Where do we think the losses were, Harinder?
Yeah, absolutely. So kind of the main areas besides Brent, as you said, is likely to be in propane. So kind of following on from Trump's tariffs, the retaliation that China then continued and imposed on the US, those 34% tariffs. Off the back of that, we saw like a massive, and then of course Trump going again with the 50%. We saw propane benchmarks globally collapse. So LST propane, which is the US Gulf Coast contract, we had FEI, the Far East Index, East Asian propane benchmark, also collapse quite aggressively. It's actually quite a bizarre move when we looked at it in kind of after the fact, because you'd expect, given the fact that exports or rather imports of US propane have now been tariffed heavily by China, you expect that prices for that to rally. But the Eastern Asian propane contract, a bit strange for that to also for that to collapse as well.
Well, case in point, to be honest with you, I've been saying for a long time, I think I even said on the podcast at the beginning of the year, basically a great tariff trade or a great, I think at the time it was tariffs. If Trump is going to do this with China, is to sell the ARB, is to sell LST and buy FEI, because that's the classic route. Like LST, the US propane is always discounted to Asia because it has to incentivize the barrels to move over. If the barrels are no longer moving over, they're going to form a glut in the US and Asia's got less propane. So I'm like, well, you just sell that ARB. Unbelievably, it's done the complete opposite. And I thank God I wasn't too much into that position, because that would have been a disaster, right? And I think, as you say, it's more the Asian propane itself, the nuances. Do you want to talk about what we're hearing about the physical side?
Yes. So one of the ideas as to why this could be happening is because US cargoes can be delivered into the FEI contract, and because China has imposed these retaliatory tariffs on the US, that would mean that, or rather, US has imposed tariffs on China, the 34%. It will mean any cargoes that China tries to purchase of delivered into the FEI contract would be heavily tariffed, and so they'd be incentivized to try and buy the Saudi crude benchmark, the Saudi crude propane benchmarks, the C3CP contract, and get their cargoes of propane much cheaper.
Well, yes, that's why it would make sense to buy the Saudi propane. So we've had a big move in Asia propane versus Saudi propane. But just sticking on the Asia propane, I guess what you're saying is, and it's still confusing me to be honest, but if I go back to, say, the Canada tariffs, it was actually the US crude, right? So much Canadian crude comes down to the US. So when that happened, when the tariffs got announced, the deliverable price into Canada, from Canada into the US, is usually WTI minus, 15 or something around there, even minus 10, whatever, just something quite low on those digits. And it was now flat, because it was like, it's going to be so expensive because I've got to pay for the tariffs and then deliver it. So I'm trying to think of that. Again, I just don't understand, because surely from the FEI perspective, it's exactly the same thing. Now you've got to pay for it to be delivered. You need to charge a lot more for the buyers on an FEI basis, on this benchmark basis for Asia, to deliver it, right? You've got to go whatever the FEI price is, or add the tariff, and I'll deliver it at that price. So therefore, So I don't fucking understand, but whatever. Maybe someone will tell me in the comments or whatever.
Yeah, I mean, I didn't get much of a better understanding, but speaking with Avik, our head of LPG this morning, he was just essentially saying that because we're going to be seeing such severe sort of barriers to trade internationally here, you're just going to see FEI flooding the domestic market,
Right.
and that's going to be the sort of main price mechanism. You're going to be seeing more sort of domestic consumption and domestic supply, and it's just all going to be internalized. Not sure I fully get it or agree, but I guess this is also why it's pertinent to call it the widowmaker.
Yes, exactly.
Because part of this is, you know, it doesn't make sense. You're seeing an absolutely magnitudinal, it's the largest diff move ever, the FEICP.
Really?
And part of that is because traders are caught on it.
Yeah.
And so you're seeing stop outs.
Yes.
So
Good point.
whilst things don't necessarily, the magnitudinal direction of them may not make sense to you, it doesn't have to make sense to the size of these things because traders get caught on it.
Yeah. No, it's bang on. Yeah. Very well put, Toddy. Nice squat.
Got one.
Animated. But yeah, no, bang on. So why don't you talk about the FEICP? Because I know you got some information on that. So to Toddy's absolutely perfect point, it's like it caught people so unawares. But the FEICP is a very crucial differential for importers, right? So from my understanding, you know, in Japan, Korea, they are selling their domestic propane pricing on the CP benchmark. So they buy FEI and they sell CP, and they do that in the derivatives as their hedge, right? They have to basically mimic what they're doing in the physical world. So they're buying that. But then FEI CP had a massive collapse. So no one knew what was going on. And we saw this for ourselves, people asking for bids in FEI, and you know, you show any bid, whack, it's straight away. You're getting, people were just bailing. And as you say, that is a widow maker. But have you got the graph?
Yeah, so we have the C3 LST, C3 FEI CP chart here.
Yeah.
So we can see it was around negative $8, kind of $8.50 per metric ton at a couple of days ago before the announcement.
If you were to zoom out on this, like
zoom out as in long term.
Yeah. I mean, this is low, right?
Super low, yeah. I think we've seen, it's going back years now.
Okay, there you go. So it's very stable around, you know, flat
Flats, yeah.
ish, and it's just okay, great. So go on.
Yeah, so this kind of aggressive move down, driven again, as we said, by the fall in kind of FEI price. Interestingly, CP did come off as well. I think that's kind of part of the whole global kind of concern for global recession and the reduction in demand.
But that's on a flat price basis, right? You'd expect that to correlate with Brent, but yeah.
Exactly. So yeah, and then if we go to the dashboard for a second, and we look at FEICP, which I have here. So this is June FEICP. And we see that from Onyx's data, counterparties are actually quite long with us. So this is kind of builds quite nicely off the Widowmaker, the fact that all these counterparties are now holding massive losses, effectively, unrealized losses, because they're still holding their positions. But as we said, it tends to trade around flat, and now we're at close to negative $80 per metric ton. So massive move to the downside, massive unrealized losses.
Okay. So I guess you could argue it's a good entry price for some respects, but if you've completely restructured, and this is where you have to be careful trading these markets, these differentials are very meaningful, right? They're not speculative contracts. They will settle basis the kind of import-export economics when it gets to pricing. It's very much used by the trade suppliers, right? They're not speccing on it necessarily. I mean, they might be, but they've got to really trade this differential as a way to hedge logistics. So a complete restructuring there, you can definitely take the other side from a technical basis, but I would be very cautious, because you've got to be wary that something huge has changed there. So that's the only thing I'd say about that. But let's move forward to trying to predict what's coming next with markets into our crystal ball section. Okay, so the routine now, we look at Brent flat price, M1, M2 Brent, the gasoline crack, so EBOB, European gasoline versus Brent, and the Asia low sulfur fuel oil, kind of shipping fuel versus Brent as well. That's kind of our proxy for the beta of the market. So last week, I think got pretty lucky saying that it was bearish. Kind of, I think the generic consensus among us was that it kind of reached almost overextended points from the Brent, and you kind of expected the White House to come out and say something at some point. And I'm always very cognizant that Trump wants oil lower, right? That's his big thing. So you know he's always got half an eye on it. So when you have a $6-7 rally, he's probably going to come out and do something. couldn't have expected what did happen though. So, but anyway, we got that. We called that with the Brent spreads. I think we actually on the VLSFO it rallied as well. That was our generic view, and that kind of performed as well. So we're in a good position from our predicting point of view. Again, this is like just luck stuff. But going forward, what do we reckon then? So let's start with Brent.
Yeah,
up or down?
I think I'm inclined to say there's a little bit of room to the upside. The reason being, so from a technical perspective, like we saw that $63 per barrel support level kind of long term might come into play. I think also the sell-off has been so aggressive that you might see a slight reversal in the short term, a little bit of a bounce back. It really does remain to be seen. I mean, it's so super up in the air, but if I had to pick a direction, I'd be kind of mildly bullish.
Yeah,
I like it. Like, I see it as a buy here. You know, the correlation with equities has been too high over the past few days for my liking. I think the S&P was overinflated. I don't think Brent was to the same degree. And yesterday, when you saw the brief headline, you know, this fake headline about Trump considering,
or leaked headline, or test headline.
Yeah, exactly.
You never know these days.
But when that came out, you saw a $2 spike in Brent in like a matter of seconds. Now, to see that get immediately back up to like $68, $67.50, despite the OPEC headline, I think there are some people that believe in this. And you know, you can talk about fears of a global recession, but if people are fearing a global recession, they're going to be consuming a larger proportion of their income on inelastic products, i.e., oil products. Like, people still need what is produced via oil.
Yeah, I think to move so quickly, like an economic or financial crisis about banking and all that, there's a good narrative there to get your head around that the economy is weakening. I think tariffs we're not used to that in our modern world. We haven't seen a global kind of trade reshaping. So I think it's quite hard for people to fully grasp if it's a real thing, if you like. So I kind of agree with that concept, but I would just go further towards what we were saying at the beginning, which was the Brent time spreads, the crude indicators have actually been very strong, like very, very strong. They've gotten even stronger after the Brent expiry in the kind of dated Brent contracts, as the spot contracts reflecting North Sea oil. They've just continued to perform and completely ignored the flat price set-off. Brent time spreads have held up quite nicely. The flies, as Manny was saying on her podcast with James Anderson, so that's, the fly is a good indicator, right? Because it eliminates the time spread beta. This is all using all this jargon, but basically the time spreads in Brent, they did go down, right? They were relatively correlated to flat price, but you'd expect a lot more correlation and Brent spreads to be way weaker. So they moved down a bit, but the way to know that they're not really wanting to react is because the nearer term time spread, so let's say June-July time spread, is moving slower down than the next month, i.e. July, August, and so on and so on. So what you get is like the relative price action. The fly is the time spread minus the time spread. So June, July versus July, August. And that has gone up, which shows you that people still believe in the prompt market. And this is a very physical thing, the time spread. And so that's a bullish indicator. As I said, the data Brent's performing really nicely. The volatility is lowered after the explosion. You kind of got down to 62, 63. And since the last couple of days, you've been, in fact, this morning was the first in a few days bullish market open. And it looks pretty healthy to me. And to be honest with you, like the refinery margins, good proxy for refinery health, and like the cheapness of the Brent price, I mean, it's still really strong, like pretty damn strong. So I just think refiners are going to buy the hell out of oil. The physical's going to be there, and the market's just not that bearish. It's just literally one price, which is the outright price, has moved lower. So I'm definitely personally bullish from here. And I guess off the back of what I just said, I've got to be bullish the time spread as well. I don't know if I can rope you guys into that thinking as well, or do you have any different views?
Yeah, I think the time spreads, so they obviously corrected downwards. We saw a pretty strong trend.
Have you got a graph for
last
the
week?
M1, M2?
Yep. So I have the time spread on my screen here.
Okay.
So we saw this kind of really, really strong trend last week or the week prior. Since then, obviously, it's kind of come down. I think perhaps this, like we said before, could there be a case that this move was tied heavily to macro markets, right? So maybe oil was reacting to the macro headlines a lot. But obviously, Brent spreads is supposed to reflect the underlying physical. So maybe there's a case here that it'll rebound because the the structure is actually still strong
as well with the front time spreads. You've got to be a bit careful as well, because in backwardated markets, so when the time spreads are positive, the hedge funds that have long positions, passive indexes, the wisdom trees, the USOs, Onyx Spot Crew coming soon. What you do is you have to roll it from the front month to the next month periodically to keep the trade live. And that means selling that time spread. So you get quite a lot of sell volume periodically through the month anyway. And generally speaking, it's quite a good indicator of how the market is going to take it. So if there's a lot of selling between the kind of fifth working day of the month onwards, and it's absorbed and it goes higher, then the market obviously wants that volume. If it can't take it, then obviously it doesn't. It's a good like small proxy. But here it looks like, the fund rolling probably has come in now. A fund manager's got to take that view. Like, do I roll now? Do I roll in a bit? How strong's the market? And actually, that's not a great sign, to be honest with you. Like, that's slightly worrying me from the bull perspective. I think it still holds. If flat price is going to retrace, you'd expect Brent to retrace. But I think the fund roll thing has to be said for those who aren't aware about it.
If I were to look to express an opinion on Brent here, saying that the front is probably a bit too volatile for me, and I'm not necessarily convinced that things are going to be resolved in a short period of time, but I fundamentally believe in Brent in a longer perspective. Would you be an advocate of selling maybe like an M1, M2 Brent spread?
What's a relative value trade?
Yeah, or do you think that's sort of maybe a mismatch of ideas here?
Yeah, I think the problem with that is it's believing that the time spreads are a reflection of the outright prices in the forward curve, and I don't think they are at all, right? You have liquidity in the outright price at the front, and then you have a time spread market. Now, a time spread market is actually kind of independent. It's the physical differentials, right? So people trade the time spreads as a way to reflect their physical view, to hedge their physical. So you've got the outright price move, and you add the time spread market, and the sum of those two together gives you the back end price. It's not like the back end price is reflective of the forward demand. I don't believe it works like that at all. I don't understand how you can mathematically say that when it comes to Brent, because the volume on the Brent time spreads are so much bigger than that of the outright price of the prompt. It just completely dwarfs it from a volume perspective. So you can't tell me that the outright prices at the back in their tiny volumes traded is dictating its own price. It's not. It's outright at the prompt, which is where the liquidity is, plus that. You get my point.
Yeah. Exactly. Yeah.
So I think, no, that would be a very bad trade if you were trying to reflect couple months time demand by selling. It's a very risky trade. I guess you could do that from a fly perspective. You could sell M1, M2 and buy M2, M3. That might work, because you are eliminating that kind of beta, like I say, and that is a relative value trade, right? You're saying, I think June, July, August is going to be on a relative basis stronger than June, July, then yeah, that would probably be quite a good trade. And then the other two, so EBOB crack performed again, right? That's been on another bullish trend. So we've been on a long bullish trend now. Yeah. And so I guess I would probably maintain that as well. I'd just go with the trend here, right? Have you got the graph?
Yep, you can pull up the graph here.
Is that the same for you guys?
I like it. I like it in Q3. There was quite a lot of buying in the Q3 region in European cracks. Things with the tariff headline, we saw rubbers sort of initially react, but European gasoline remains strong. The market is positioned long into Q3. So I think you're sort of with the herd a bit in that part of the curve. And yeah, I fundamentally don't believe that it's all doom and gloom. So I like EBOB, and I like EBOB especially in that sort of summer gasoline.
Yeah, we've talked about this before, but it's quite a nice trade to be in whilst the open interest is quite balanced, because Q3, the market likes to buy Q3.
Yeah.
It likes to buy dips and buy dips in Q3. So that will be a nice one to trade, especially if you can see that the open interest is not oversaturated. Can you just quickly grab that? Get that up.
Open interest on front month, or you after?
No, Q3, Bob.
Q3, I can get one of the legs.
August or whatever, yeah.
August, yeah.
I think also it's worth noting that ultimately, if you had a week ago given me the opportunity to get into Q3 at sort of $13 per barrel, I might have said, oh, I've missed it. Whereas you've got another opportunity to enter on this dip here. So yeah. I think...
so this is okay. This is EBOB crack in August, and the open interest is, absolutely fine, right? We're not even outpacing. Oh no, sorry, we're outpacing the open interest because it's the green line, right? So the green line is basically where we're at now. The blue line is the 5-year average at this moment in time. Okay, so it is outpacing, to be fair, which you would expect because the price is being lower, people scaling in, like you're saying.
Historically, you have more market participants now than you did 5 years ago as well.
Sure, but I just mean in terms of like if it was 20 already, you probably wouldn't have as much interest in this.
Yeah.
So that's okay. You would be worried if it was approaching the orange line too quickly, right? Because that's the kind of ceiling we've had in the last 5 years. Like you say, it could still surpass that safely because of there being more participants. But generally speaking, I'm just saying you've got a decent amount of headroom. We've got about another 7 million barrels before we reach of open interest before we reach the kind of danger zone, as we like to put it. So I quite like that momentum trade. And I guess the last one being the VLSFO crack in Asia. Again, probably the one I'm like least kind of versed on, I would say, being a newer contract, but we were bullish it just on the back of it probably being oversold for kind of a bull run, and actually it performed really nicely on that sell-off, which I don't know if I would have said, because sometimes you do get quite strong correlations with this kind of VLSFO market, this shipping fuel market with Brent, but other times clearly it can be completely decorrelated. So that's an interesting one. But again, from a technical basis, which I guess we could base this on, it's a pretty bullish setup, right? It's breaking up. Do you want to talk about that?
Yeah, sure. So last week you mentioned that there could be a volatility breakout to the upside. That's sort of exactly what's transpired. So the Bollinger Bands had widened prior, which is a sign of volatility increasing. They'd narrowed, so volatility had dropped, and now they're sort of widening again as we have this breakout to the upside. Yeah, I mean, that's pretty much nice.
Okay, so we're all aligned. Consensus trading.
Generally, yeah. Glad you corrected me on the Brent spread though.
Yeah. Oh, did you like that trade? You can go for that.
No,
so you're bearish the Brent spread.
I don't mind it as an expression.
All right,
but
fair enough. All right. It's good to have some discourse. That's what we like. I think the only thing I wanted to bring up as well was just because I want this to be as trader focused as it can be. Can you get up the Q4 Brent Dubai? Because that was something that was talked about last week by Vincent when he was Geek in the seat. He was talking about buying Q4 because he felt that Brent Dubai was skewed from a risk reward perspective because of the positioning. He was saying that people were way too short that contract, like they kind of historically have been in the last few years. And it was quite a safe trade to be long Q4. So yeah, this is exactly it. So we wanted a stop around minus 50 cents and an entry around, I think we said, it was minus 20 we think would be realistic to get in.
Yep.
So look, that's been really nice setup. I mean, we know this is what's interesting about Q4 versus the prompt. Again, going back to this forward curve concept. We'll have a look at it in a sec, but the prompt contract, i.e. the May contract, has like roofed about 70, 80 cents, which is a big move on the upside of Brent Dubai. So that's really come in on Vincent's view, right? That there was too many shorts. And as soon as you get any bullish news, which you got because of OPEC saying they can produce more and because Saudi's lowering their OSPs. So basically saying we're going to sell our oil like cheaply as well as the benchmark price. So those are two very bullish things for the Brent Dubai price because it's weakening the Dubai part of that. So you would expect the prompt to outperform because it's more volatile. But what we were saying was if you buy Q4 and the market still weakens on the prompt, you're going to be okay because of the boxes, right? Like the forward curve works like that like May will like underperform Q4 and Q4 will be more stable. And that's worked out quite nicely. But then on the flip side, it was a bullish move and you got quite a healthy bullish move in Q4 and that's working quite well. So again, just back to the graph, we said minus 20 entry, minus 50 stop. I think we said we'd scale in at minus 7 cents. So it's already gone positive. So it would have been choppy though, right? So you would have got in at minus 20, you would have got your scale in point, but then it would have shot right down. I think we said, it's actually in the comment sections of our last video, we went back to being precise about our trade idea there. And we said, buy at minus 20, stop at 50, scale in, double the size at minus 7 cents, and then move your stop up to 32.5 cents or 30, let's just say 32 cents. So that's actually working out really nicely. So that's playing sort of, even though it's been relatively volatile, that trade structures work quite nicely. So you would be, if you'd done that trade, you would be in an average entry of around minus 13 and you'd be running that right now. And I think we set a target price of 7, 8 plus 7 or 8. So this is working really nicely. So at this point, you can kind of see it trending north. I would be saying, look, take some off soon. And again, similar to how we said on the Nat for crack, take half off and then run the rest and start bringing up that stop periodically. That's worked out really nicely. So yeah, that's a good one to review. And yeah, so like going forward, I mean, is there any other trade that we like? Anything anyone can think of? And we've been through quite a lot.
I mean, yeah, I think obviously the gold rush, the MopJ crack, I really do see as a winner. And one of the other things to tie in other segments of the show is FEI MopJs were quite supported, and we've seen FEI versus CP coming off hugely. So, putting 2 and 2 together, I might hazard to guess that we're going to be seeing more FEI MopJ buying and more MopJ selling.
But the FEI part is just very, I don't want to go near that. Yeah. So I mean, personally, I wouldn't recommend it because it's just, if we're getting confused about if we're getting confused about the physical side and its pricing impact, I mean, like, why would we suggest a trade on that basis, right? You'd be pretty nuts. But in any trade, you can set up kind of a safety style trade. But when you've got a market like FEI, it goes bidless. Yeah, like you literally cannot get out. So it's all well and good having a stop, but in a market like this, there is no stop. So you're done in. So you're going to have to give that risk to Onyx. You're going to have to deal with it. That's kind of what we do. Okay, so now we're going to hear from the officials guys, who are our publishing arm and who focus on the physical pricing. Okay, guys, so how's it going?
Pretty good. It's been a big week, as you've been mentioning, and obviously tariffs. But in the physical, the main thing this week has been the OSPs. On Sunday, we got both Aramco and ADNOC OSPs for May. And there's some interesting stuff going on, because you need to look at, for OSPs, you need to look at the Dubai structure, and particularly the Dubai physical premium. So that would be spot to buy against M2 swaps. So that's been moving pretty significantly in the last couple of months. And in calendar February trading, it averaged about $3.34 per barrel, but then fell to an average of $1.38 in calendar March. And these OSPs are the prices that the Saudis and the UAE use to sell on tender to their clients, to their customers. So, and the most important one is to Asia. So the Dubai physical premium move would have implied about a $2, maybe a bit less of a cut to those OSPs, but they cut the benchmark Arab Light OSP even more aggressively from Aramco by $2.30. So yeah, do you want to explain why?
Yeah. So the change in OSPs is effectively based off of the relative strength of the Dubai structure on a month-on-month basis. So in calendar March, we were trading May barrels, and the OSP, which sets the price for tenders in May, was issued on the 6th of this month. As we can see from this chart here, we had a pretty big chop to the Asian benchmark Saudi Light OSP. They effectively compensate the producer for like the level of backwardation in the market. And as Ed alluded to, that's measured by the physical premium. And one key aspect here that's worth mentioning is OPEC announced that they would release an extra 400 KBD worth of supply. Saudis themselves will be unwinding about 160 KBD of voluntary cuts. Saudis haven't faced the same compliance difficulties as the UAE or Iraq have, which implies that relaxation of voluntary cuts will actually materialize into more supply. And obviously the time spread structure is a function of physical demand in the prompt. So this means that the unwind will necessitate an increase in production, and therefore the additional cut to OSPs is likely an effort to create room for that additional production against kind of a relatively muted demand backdrop in Asia. Especially
it's a bit of a market share play, isn't it? Because we've had a very strong Dubai benchmark, and that's been leading the way. Got a surprising change in narrative from the Saudis and from OPEC to suddenly say, despite a price decline, in the middle of this price decline down to below 70, you got OPEC coming out saying we're going to produce more. That's very unusual for them, especially in the last 4 years. And then to come out with official selling prices that are cheaper than expected, all suggests that they're moving towards more of a market share perspective. And it kind of says to me that there's something going on behind the scenes because it's a very unusual move. But I guess from a trader perspective, Dubai being so strong on a relative basis has meant that people have very much liked being short Brent versus Dubai. So the Brent Dubai having a big rally is probably a lot in reaction to this OSP situation. And I think there's probably quite a lot of stop outs. But how's the physical pricing been this morning and I guess yesterday in Dubai?
Yes, yesterday was the really interesting one because that was where it fell by, the Dubai physical premium fell by 94 cents. So as you say, the structure in Dubai has had some space to unwind, to soften. And then this morning it ground down by another 4 cents to 128 by our assessment. So clearly there is still some room for the Dubai physical premium and the Dubai structure to weaken further, especially given the Saudis seem a bit anxious with this big OSP cut, a bit anxious to place those barrels into the market. So I think there is definitely room for the Dubai structure to weaken further. So maybe a long.
But this is very difficult to trade, right? You try and trade we call it the bow month contract. I mean, you can get liquidity on it and it can move very violently. So a 94-cent down move is, from a percentage perspective, it's quite hard to figure out because of the ranges can be negative and time spreads, but it's kind of equivalent to like a 50% move, right? It's a big hit if you're long, and that shows you the danger. And I guess obviously there are longs out there who would be hurting right now, and that's made the Dubai market very tricky. So yeah, unexpected, a bit of a widowmaker actually, maybe to relate it kind of to what we were saying earlier. But generally speaking, yeah, this is why it's so important to hear from you guys, right? Because what's going on from the producers and their mechanisms and physical pricing is kind of reflective of a move from them. So that's really great. And I guess to finish it off, I guess is that now a change in mentality in the Middle East? Is that now, are we in a different regime now with Middle East supply? Do we expect more from OPEC?
The UAE and Iraq announced also that they would be unwinding some voluntary cuts, but they've been overproducing, at least by our data, pretty considerably. So it's unclear as to whether that will be an improvement in compliance and no actual release of more barrels, or we'll see a continuation of poor compliance and more production. I think probably the former on their part, but for the Saudis, it definitely seems like.
Well, I guess unexpectedly as well with tariffs, it's going to be a lot more expensive to import US, so you can import more Saudi, right? Ultimately, so maybe that's all it is. It's just a rebalancing. So it's going to be interesting, and I think important to keep hearing from you guys. And the officials is a daily newsletter that's posted on LinkedIn. Be sure to check that out under these guys' profile, and Jorge Mentepeke as well, leading that. So thanks, guys, and see you again next week.
Thank you.
Okay, so that leaves us at the end of the Flux News Show. Thanks very much for listening. Remember, you can get Flux, the terminal, $400 a month, or free if you have a trading account on Onyx Markets. Be sure to check out flux.live. All the stuff we're talking about, lots of free information, lots of good stuff out there. Be sure to check it out. And thanks, Harinder and Toddy, for joining on this session. And see you again next week.